Good evening, everyone. I'm Umesh. I'm heading ETF sales for Mirae Asset Mutual Fund. We are back again with another session, another discussion on the topic which is, in discussion across when it comes to portfolio management, when it comes to uh, did we miss the rally? Should we enter again? What is actually happening? And I think last session, first of all, thanks to all of you for giving us a lot of love, and we got lot of people joined in, and there are a lot of queries about these products, these commodities. So we want to discuss more in detail. Today we have another speakers from the industry to talk to give other perspective of both the commodities, gold and silver. Before I introduce them, I'll just quickly take you through what is happening. So these are very interesting, exciting times when you see the gold is at lifetime high. If I look at only the gold price, the prices has gone up significantly in last say 13 days. The gold has made five lifetime highs. Every time there's a new high, and that is where the gold is, going up. And if you look at the ETF AUM or the overall India ETF holding on gold is close to around 95 tons. That's where it is inching up and it is growing significantly. Similar way, the silver ETF holdings or in India is close to I think it has closed 3,000 crore, sorry, 3,000 ton, which is significant growth in terms of numbers. Now coming to this thing that okay, it looks like that the females in our homes, they are better investors now because lately gold has delivered something exponential which has outperformed equity returns also for a longer period of time. And I think if I look at in terms of holding, I think Indian household uh, hold more than the market cap of BSC when it comes to gold price now or gold valuation now. If look at rough estimates closely, Indian household hold around 35,000 tons of gold, which is at current pricing, it is around 525 and maybe more trillion, the size, the value. Whereas the BSC, the market cap is 475 or something. So it is beyond that. So that is what the power of saving or the maybe our association with gold or silver now with the time has come up. So I think these things are very exciting times across industry. We are talking about all meetings. We are talking about similar kind of things to have this discussion forward. To take this discussion forward today, we have one more specialist from the industry, Mr. Chirag Sheth. Mr. Chirag Sheth is a principal consultant for South Asia and head of India office at Metal Focus, a global precious metal consultancy and research firm. He has over 20 years of experience in precious metal, working for UBS and Latin Manhar Lal Commodities. Chirag holds a bachelor degree in management and a postgraduate degree in management and finance. He is on the product advisory committee of NSC, IIBX, MCX, and BSC. So, welcome, Chirag, for this discussion. Uh, the second speaker, obviously, you know him, and again, I would like to introduce is Mr. Siddharth Srivastava. He is head of product and as well as fund manager for Mirae Asset Passive. I think he has been a voice from our side when it comes to the innovative products which we are launching, and also from the ETF as a concept. So, welcome to you to Siddharth on this show. So, I mean, these are, as we all know, these are very exciting times, and everybody is now want to know, want to get answer of few specific questions. And I think every second question is on the same lines. And I think I would like to start with you, Chirag, is that the both gold and silver, there are you can say on record highs, and I think the targets which are given for say year uh, duration of year are being completed in months. So that's how exciting or interesting time is. Though let's start with the topic of this panel is that, will this rally continue? The first thing is, and if that happens, you feel, or whatever is your take on, what could be the key factors you feel are going to support both sides in this rally?
Sure, Umesh, thank you very much. Firstly, I'm really grateful to Mirai for inviting me on this webinar. You are absolutely right. These are really, really exciting times. As somebody who's been tracking precious metals and energy, I've been doing this for 20 years, and this is something which is really fascinating. What we're seeing in last, probably couple of years, and you are absolutely right. Like we had a target of $70 in November, and that was for 2026. And look at what has happened to silver. That came just literally in a month's time. I think it's very important, Umesh, to understand that why did we see the kind of rally that we are seeing in both gold and silver. Fundamental aside, there are few very, very interesting things that is driven. I'll take probably silver first and then move towards gold. So I think silver has had a phenomenal run in last 2 years, right? But if you actually take a step back and look at the silver market for last 3 or 4 years, you will see that the silver market has been in a deficit. So essentially, your supply is limited, but the demand has been consistently increasing. Now, the growth in demand that we've seen in last, I would say, at least 5 years, the incremental growth has basically come from three important industries. Firstly, photovoltaic, which is solar. So we've seen, probably if you just look at a 10-year horizon of how solar installations have taken place, you've seen an explosion in installations over the last 10 years. Probably, if there were 15 countries which were having solar installations early part of the decade, now we are looking at at least 3 to 4x more, right? So that is something which has brought in incremental demand. But also you've got EVs, essentially both on the storage side as well as on the EV batteries, and cars have seen an incremental demand coming in. And as your aside EVs, as your cars become more and more high tech, right? You will see more silver usage. So for example, in today a modern car, you've got at least more than 200 touch points where silver is getting used. While it's important to understand that even at these 200 touch points, your silver usage per car is more like 12 to 15 grams per high tech car. So as your cars become more and more high tech, your silver will go up, right? While market has been in deficit for 3 4 years, why did suddenly we saw this explosion in prices? And there comes the US tariff policy. Okay, so there has been, kind of fear in last probably 6 to 8 months time since Donald Trump came in, that US might put tariffs on silver. Another one is US might, you know, kind of say that the silver is a critical mineral and it needs to be protected. Now, what that led to was, usually in precious metals, the flows happen from west to east, which means that west is a supplying market because most of the banks, large banks, trading houses, or are based in the west. East, especially Asia, is the consuming market, right? So that's how precious metals tends to flow. Given that there were restrictions on tariffs, given there were fears of tariffs and possible restrictions on silver movement, silver started moving from London to New York. So, what essentially happened is that in an already deficit market, which is kind of getting tighter by the day, there is an artificial tightness which got created because metal moved from London to New York. There is a lot of metal which is sitting in New York right now, not doing anything. In London, the metal is limited because a majority of the metal in London essentially is tied under ETFs. So that cannot move out. So the availability of ready metal is limited. And then you had, during September, October, November, you had explosion in Indian demand. So what is essentially happening is that you already have a shortage. Because of this tightness gets created. Tightness leads to higher demand. Higher demand leads to higher prices. Higher prices leads to more demand. More demand leads to further tightness. So we've now got into a vicious circle. So unless and so your second question was what will flip this, right? Unless and until this circle is not broken out, we may not see a meaningful correction which may come in. So unless this circle keeps on continuing where there is already tightness which is in the market, and this is creating further tightness. So metal from New York has to start moving out. While there is a bit of trickle which has started to happen, it's not significant enough to, I would say, really ease the pressure in the market. So that I would say is happening on the silver side. Gold, I think, is more absolutely a geopolitical story. And I think gold, if you look at this, has been driven by two significant drivers. One is central banks. We've seen that in 22, 23, 24, central banks bought about 1,000 tons of gold each year. I think 2025, we are looking at anywhere between 700 to 800 tons of demand. And second, we've got the fact that post the US Ukraine of dollar, and that has led to flight of safety towards hard assets, especially gold, from ultra high net worth individuals, family offices. And these two, and given the way Trump has been managing his administration, the fear about Greenland and tariffs and global geopolitics have been leading to this rally that we've seen gold. So I would say unless and until geopolitical tension doesn't ease out, and essentially it's very important to understand that gold to us is a stopgap agreement. Uh, Central banks are trying to diversify it out of dollar, but you don't have any other currency where you can put your money into. So essentially, gold is a stopgap agreement. Till the time this doesn't ease out, I would say it's very difficult to take a sustainable negative view on both gold and silver.
Interesting. I think you made very interesting points about silver as well as gold. So, Chirag, just maybe just a follow-up question on this. Now, if you look at 2025, gold has given return of around 67%, which is the highest since 1979, or if you
Yeah.
look at annual basis. Now, coming to silver, it has already given 160% kind of return in a year, which is the more almost double the return from gold. Should I book the profit?
Well, that's a very good question then whether we can book the profits or not. But I would, it's difficult. I would say that one should start to be very, very cautious, especially in silver, given the fact that especially in last 2 3 months it's run up quite significantly. Also, some of the factors that led to this whole push, right? The whole news about China banning silver exports or restricting. It's very important to understand that out of the 36 companies, 34 companies have already received their licenses. Usually, China also directly doesn't export to the world. Flows move in from China to Hong Kong, and then it actually spreads to everywhere. So I would say there are a lot of factors or a lot of news which were not relevant, which were blown out of proportion, and that has led to this rally. So I would obviously be very, very cautious. I don't think the tide has still turned, especially for gold and silver, right? As a research company, as a consultancy company, we still think there is more upside for both gold and silver. But we also think that the risk for the downside has increased quite significantly. So we believe that probably in a single quarter, you could easily see 10 to 12% movement in gold and silver prices. We already saw that in last few days, right? You saw Greenland issue, Trump made certain noise, and then we've seen in India premiums kind of reduce quite significantly. Also in comics, bit of profit booking coming in. So we believe that we are now at a time where we'll see increased volatility and corrections could be very, very steep.
Fair point. So I think now I'm an investor and I maybe I'm in FOMO. I missed it. I thought ki this will not going to happen, and it happened actually.
Yeah,
So now, if I want to enter, now if you look at the data, silver, in case of silver, I have some data. It says that India already imported 6,000 tons of silver, which is
yes,
around 20%, 25% of global supply.
yeah,
And if when it comes to gold, it is, I think we are the third largest ETF when it comes to ETF inflows in gold. And
yeah,
it's around, if I'm not wrong, close to around $4.4 billion. Now,
right,
both commodities are going hand on hand. Now, if
yeah.
I choose one, should I choose one or should I go with both? That's also one question. And if one, then why?
Look, had you asked this question probably a year ago, I would have told you that silver looked really strong to us, and we believe that silver would outperform gold. But at this moment, I would say there is far more comfort in gold than it is in silver, purely because of the run up that has we've seen in silver. So I would say gold still has upside, which is there. And we think that at this moment, probably gold will outperform silver over the next 6 to 12 months time. That's what our forecast is looking at. So if you were to choose one, then obviously I would say the one which is outperforming. But it's very important that we've always said this, that gold and silver both should be part of one's portfolio, and I think that is something which I would still reiterate, because I do that. Gold and silver is part of my portfolio. Because it's very very important, because in tough times these will generate excess returns, or will safeguard you, as they have done in last 2 years. But at this moment, any fresh investment into silver, one has to be a brave heart to do that.
Okay, fair point. Got your point. So on this, I think I would like to come to you, Siddharth. I think Chirag has mentioned many things, his and organization views in that sense. Siddharth, I have two questions with you to start with. First, since you have been managing ETFs, and I think when it comes to investing into commodities, I think ETF is something which has picked up well globally. No, not even in India. In India also, last year it has shown significant kind of flows. So, how it works, which is if you can help us for an investor, because earlier there used to be, you can say, gold bonds, which are now not there now. Investor, what should they do? And if they want to do ETF, what are the things you would like to maybe highlight here? One. The second is, uh, what about the premium discount? Because lately we have seen, I mean, 2 days back also, things are happening. So maybe you can just address that also, will be helpful for the audience.
Sure, Ramesh. Again, thank you everyone for joining us for this webinar. So, I think ETFs are no more, let's say, unheard of when it comes to commodities. Ramesh, we know that recently gold and silver put together crossed 2 lakh crores. So, it's a big category now. We have seen a huge amount of inflows. Last month itself, we saw around 17,000 crore, if I'm not wrong. Today, I was checking, Umesh, gold ETFs, I think traded around 6,700 crores on a single day. Uh,
Wow.
and, and silver ETF traded around 20,000 crores on a single day. So gold ETF was 6,100 and silver was 20,000 crores. So just imagine 6,100 for gold. And who would have imagined that silver will be almost three times more at 20,000 crores. So that is the appetite which we are seeing. Also, aided by the fact that this is one of the regulated ways to take exposure in commodities in both gold and silver. Uh, all these are backed by physical bars. I think that is one question we get a lot. Uh, so for gold, we buy LBMA certified 995 purity, which is equivalent to 24 carat, 1 kg bars typically. And for silver, we buy LBMA certified 30 kg bars, 999 purity. These are stored, these are volted. So you have physical backing to all these ETFs. So that concern which people typically have of physical versus paper does not apply in case of ETFs. No issue of making charges, no issues of theft, purity risk, etc. So that's why we are seeing significant demand. I think if anyone is looking to buy, we can talk about timing and all, but I think ETFs are a no-brainer right now. Now, the second question is, I think, much more complicated, right? So let me try to answer it. I'll take a bit longer time to answer this question. So both gold and silver track the spot price, first of all. So whatever is happening in physical spot market is what ETF will typically track. So if in physical market gold is moving from X to Y, the ETF is also expected to move from X to Y. So please don't benchmark, please don't sorts of compare it against LBMA prices, because it is not exactly equivalent, and also do not compare it against MCX futures. While there is linkage in everything, right? Futures is based out of spot. LBMA prices is something which is on which domestic prices are based on, but ETF track physical spot market. Now, hence, the performance is typically linked to whatever is happening globally, plus domestic premium and discount, plus you're converting the rates based on USD INR. So all these things are a factor. Now, where does it differ? It's the premium and discount, right? So one thing is happening in international market, completely another thing can happen in domestic market. So what I've done is I've taken out a data, Umesh, and for everyone's information, if I look at, and this is a bit complicated, if I look at 12th of Jan, the premium discount was only 500 rupees, and that was discount minus 500 rupees was what spot was versus LBMA gold. Okay, I'm talking in terms of INR. Then it remained 650 on the discount. What happened yesterday that it moved up to 3000 rupees premium. So Indian markets started trading at premium. Yesterday markets were at premium for multiple reasons. I think typically if you look historically around the budget, there is some amount of speculation which happens, whether there will be a custom duty cut, whether bullion traders are sorts of scared to hold more inventory, etc. So you see some amount of speculative trading. So yesterday, Umesh, we saw a premium of around 3,200 rupees in gold, and you won't believe around 19,800 rupees in silver. So what happened yesterday? Silver closing internationally was around 94.85. Okay, so 94.85 in dollar terms, but in India, when I'm looking at spot, it was almost equal to $100 NAV closing. It went as high as $107 on an intraday. In fact, ETF closings were around 103 and $104. So what happened yesterday, that silver was trading at premium, international prices were around 94, but in India we were looking at prices around 100 and 107 intraday, and we closed somewhere around 104, and the NAV came out to be around $100. So we were at premium. Today, what happened? That premium sorts of got normalized. It came down, not significantly, but if I'm comparing, so it seems like yesterday when we were at around 20,000, today we are around 7,000. In dollar terms, when premium compared to spot was around $6.7, today it looks like it is between $2 to $3. So premium has got down. Premium is still there compared to international prices. There can be multiple reasons why yesterday it was trading at a significant premium and why it has sorts of come down today. Because international prices, to be honest, has not moved significantly. So, like I mentioned, that there is a base which is international prices. Then you add premium discount, which is driven by supply demand dynamics. We have to add a budget angle also, that if there's a news around custom duty, and there's nothing which I have heard of, but typically we have seen that before budget there is some amount of volatility which gets built in gold and silver, which we are seeing right now also.
So, Siddharth, just to one more question on this, you just to explain. Thank you so much for this explanation. This will help to our audience. Uh, how this premium or discount thing, which you said that yesterday it was on premium, today it is the premium is getting normalized. Who decides it and how it happens? I mean, if you can quickly touch upon that, also will be helpful.
Yeah, that's a great question. So see, ultimately the role of uh, ETF is to mimic the underlying prices.
Okay.
So it is nothing but what is happening in physical spot market. Who decide physical spot market? In case of stocks, it is the buyers and sellers on the exchange. In case of commodity, it is typically the bullion traders. And bullion traders are basically deciding based on obviously multiple things, right? Uh, Obviously, it all depends on supply and demand also. So it is bullion traders typically who are looking at what is the physical market value should be, and ETF ultimately replicates that. If tomorrow, for Ramesh, let's say suddenly because of XYZ reason, there is a demand deficit, you may very well see silver and gold actually trading at a discount. So while there's a premium of, let's say I was saying that yesterday silver was around 19,000 premium, today looks like 7-8,000 premium. Tomorrow it can be that it is back to minus 3,000, minus 4,000 discount. So that is what we are seeing, and it gets obviously sorts of amplified because of the volatility which is already there in gold and silver.
Mhm. Okay, understood. Fair. I think thanks for this explanation. I think this will help because nowadays we have seen several times these kind of scenarios, especially in silver. We have seen that there are times when you find valuations in terms of the prices are have gone up. So coming back to you, Chirag, on this. So you explained very well that how why you feel that this rally can be continued and you can still expect some kind of maybe returns or maybe you are positive. But is there any specific event or anything which you maybe since you are doing research on these things, do you have or do you foresee or can foresee anything related to that? Okay, that can kill this rally. Any specific event or you want to highlight something which investors should keep in mind?
Sure. Sure. Umesh, if I can just add on your question on premiums, what drives it, since we look at physical market quite closely. So I think, Siddharth was absolutely right on that front that firstly, over the last probably, I would say a week or so, there has been this fear in the Indian market, as he rightly pointed out, usually before the budget, you've got this kind of always a fear psychosis, which comes in the Indian bullion market that there is a duty increase which could happen. And that's why actually we saw that on the landing cost vis-a-vis MCX, you were, actually, kind of 7 to 8% higher on silver and probably 2 to 3% higher on gold because there was an additional fear that given the imports were so high, purely on a value basis. Because if you actually look at on a volume basis, we are down actually on year. Yeah, because last in 2024 we did about 805 tons of gold imports. On in 2025 we did roughly about 650 670 tons of import. If you actually look at silver, we did about 7,100 tons of import in 2025 and about 7,500 7,600 tons of import in 2024. So actually on a volume basis we are down, but on a value basis, given just because what gold prices have done, so there was a fear that some restrictions could come in, and today we've seen kind of premiums have gone down, right? But taking a step back, it's very very important to understand that what drives premium and discount in the Indian market, right? So there are three important aspects to that. While demand and supply plays a very important role, I would go one step ahead and point about what is the supply. So in India, gold, if you actually look at it, would come in three different forms. Okay. So you would have the banks which would bring in refined gold, LBMA, which essentially ETFs and other players would actually buy into. Then you've got Dore, which is kind of impure gold, which refineries buy into. And third is gold, which is coming through free trade agreements. Okay. Now, what happens is that depending on what gold is flooding in the market more, the premium and discount will depend on that. Uh, So if there is more Dore, then the Dore guy would be able to provide certain amount of premium or discount in the market, right? If it is coming through free trade agreement, then your premium and discount would be dependent on a certain way. If it's banks, which is more than banks would always trade at a premium, right? Because of LBMA gold and all those things. So that is something which would drive your premium and discount. And when there is a shortage or news, then your premiums tend to shoot up far more. So that's what we've seen in last probably say a year or so when we've got these times of excessive premium. So I think that's what essentially would drive.
So it is right to say that there is not only one element, there are multiple elements which can
Absolutely,
impact the premium and discount.
absolutely. On your question about what could change, right? So for silver, one key risk that we look at is if this dislocation that we are seeing, that metal moving from east to the west, if it once again starts moving to the east, then the pressure would ease out. So whatever froth has got created in the market or the excessive alpha which has got generated, you will see kind of a steep correction which could come in, because then your premiums will start easing out. So you are seeing physical premiums in Shanghai, you are seeing physical premiums in Mumbai, in London, in New York. Those premiums would start easing out, and that could lead to pressure on the prices, right? So that is for silver very, very significant, which could have a short term impact or an immediate impact. Over the long term, I think we are basically looking at something that we, in technical term, call it thrifting. Okay. Thrifting means when certain industries are using silver for their industrial usage, if the price goes beyond a point where it is difficult for them to use silver. So let me give you an example. A lot of our normal modular switches used to have quite significant silver in it. But as silver prices rose beyond a particular limit, lot of these modular switches that we find in our houses, the normal switches, they started move towards plated silver. So there is no longer pure silver which is going in. It's plated silver with copper, nickel, tin, whatever is resistance, right? So if silver moves up beyond a certain point, which is difficult for the solar industry or for the battery industry to use, then we'll see industrial demand getting impacted. So for solar, we've already started seeing over the last 3 or 4 years, they are using silver, so copper along with silver. Certain industries are using nickel along with silver, right? So when this thrifting kind of picks up quite significantly beyond a certain point, then you will see the industrial demand kind of reduce, and that will lead to the easing of deficit in the market, right? With regards to gold, I think more importantly, it is driven by geopolitics at this moment, and it has behaved purely as a fear asset. So I would say, till the time geopolitical tension persists, till the time there is fear among individuals, ultra high net worth individuals, family offices, central banks, you will see gold, kind of continue. Now it's very difficult to say whether the pace will continue or not, but till the time there is stress in the global, geopolitical arena, I would say, that's when the turning point would be.
Yeah, I think so. Just to answer about silver, I think that's my related to that. I have another question to you, maybe the follow-up question. We have been hearing at the start of the year, we and 2 years back, we heard that copper can be the new gold. Then this the way proceeded, and towards the end of 2025, we started hearing that copper can be the new silver. So that discussion is coming up now. I think people are saying that copper can be the hero in terms of, because now the copper people are thinking, companies are thinking to replace copper, may replace silver with copper. So I have a question with you, which is actually two questions. One is, A, is it really doable? I mean, I'm sure moving from one commodity to another, one metal to another, it is not an overnight process, because the industries, they might be taking time. And if yes, then how much percentage you believe that shortage can be, or my kind of demand can be impacted? Maybe if you can.
So
Yeah.
sure. So at this moment, it's very difficult to say, Umesh, what is the percentage of, I would say, shift which may happen. But one thing which I can tell you is that over the years, usually wherever industrial precious metals is used, and here it goes across the board for gold, silver, platinum, palladium, rhodium, which are essentially used in various industries, right? Whenever a breakthrough happens, companies usually start working on reducing the loading on, it's an ongoing process, right? So for example, even for solar, which is the big driver, right? If you look at the amount of silver loadings which was going into solar probably 10 years ago, it's actually half of that, not even that, it's less than that, right? But I think what we essentially look at is the penetration. So obviously, as I said earlier, probably 10, 15 years ago, there were 10 countries where there were massive solar installations. Today, it's more than 50 countries where there are massive solar installations. So while the thrifting takes place, the expansion of the usage also takes place, right? So, for example, mobile phones. The amount of gold or silver was used in mobile phones earlier, it's lesser than that. But just look at today the amount of mobile phones which are getting produced. So I think that's where that's the most important part. But I think if technically the shift has already started to happen in many applications.
Okay.
So unless until the demand for those applications do not significantly change, right, you may not see, I would say, a complete shift which is happening. So while the deficit may ease out, right, at this moment, the supply still remains fairly constrained.
Fair point. So I think thanks for that explanation. I think this that will help. Siddharth, coming back to you, I think we have been talking about, especially when it comes to gold, that it's a perfect hedge. And now there are volatile times ahead, both sides. So what do you say now for keeping this? The two questions I have. One, what do you feel how much allocation investors should have in their portfolios when it comes to gold and silver combination, or maybe individually? And will it behave like a hedge again going ahead from here also?
That's a great question, right? Especially at the levels where we are. But see, earlier we only used to think about gold and silver, especially gold, as a hedge. Now we are talking about value creation, right? And that story has been there since, especially for gold, since last 2 3 years, and for silver almost now 1 year or so. So no more it's about hedging. I think, Umesh, whenever anyone is coming to us, they're not talking about that I want to hedge and hence I want to invest in gold. They want to make money. Interesting time from an investment point of view. See, when we were having this conversation around 6 months to 1 year back, we were very bullish and saying that we can go as high as 20, 25%, 30%, even if you want, towards gold and silver, right? And silver also, we were bullish, probably a bit more than gold, because silver rally came a bit later, gold rally started much earlier. Even now, I believe that if you have a longer horizon, uh, I think 15% allocation is something which you should look at in your entire portfolio. Uh, like it's already being mentioned by Chirag. I think right now gold looks more attractive from a risk reward point of view than silver. Uh, but silver has surprised us. I think when we were making uh, an outlook in early December, we were talking about if silver touches 65, that will be great, right? It happened with before we even published the outlook within next week, and then it crossed 72. We saw hurdles at 72, crossed 77, then there was resistance at 84, crossed 90, 94, etc. It's very important to stay invested. The most regret is for people, Umesh, who have exited silver at 50 rupees, $50 or $55. Same with gold. At we're having this conversation at 4,000. At 4,000 is something, and now we are sitting at 4,800. So invest. Probably don't over allocate right now. Take some. You can be around 15% or so. If I have to sorts of look at the portfolio allocation, probably let's say 60%, 70% towards gold, 30, 40% towards silver in that mix itself. Uh, Silver will give you opportunities in terms of entry levels. It's a highly volatile. We have seen in last 2 days itself. Gold, I think, will behave more sturdy because of central bank buying, because of what is happening geopolitically. We all heard speeches in Davos. I think by listening to that itself, my conviction around gold continues. So both commodities are good, but be more cautious of silver. It is volatile. Don't over allocate, and obviously stay aware of how the markets are behaving in both the commodities. But gold looks more steady than silver.
See, I have question, which is my personal question. Actually, most of the time I also personally feel, okay, I bought gold, I'm buying silver. Now tomorrow there is a news or there is something happening in the international market or Indian market, and which says that okay, now you should increase silver, or maybe vice versa. How an investor can come to know one, and if uh, I don't know how to rebel, and I don't know how much to rebel, when, what to sell, buy, and that obviously that will attract some tax implications also. So, I mean, isn't it good to go for something which is a mix of both? What do you suggest?
Yeah, I think, see, gold continues to remain a no-brainer. I think even at these levels, if you are investing for 3 years, 5 years, even at these levels, I think gold is good to go. We always have been talking about asset allocation of gold plus silver, where you invest 10% in or so in gold and 5% or so in silver, or 3 or 5% in silver. I think people who have done that are the winners, right? Asset allocation is key. Uh, Question more arises when you're doing tactical call, Umesh. For example, 15% is there, but if you have invested, let's say, 5% more or 10% more, gone a bit more bullish. A lot of people have done that. We have talked to clients who are saying that my portfolio is 25% gold and silver, 15% out of which is silver. So there is no harm in profit booking. I think Chirag has also mentioned that if you want to book profit at $85, $90, you can book some profit. There's no one at these levels, no one can say that they know where silver is heading, right? If you look at technicals in one way, we are looking at 100, 10 levels, etc. 100 level which can be easily breached. But if you look at differently in terms of volatility and how violent the rise has been, people will say that it can correct quickly too. We are talking about a resistance at $80 and then at $70. So booking profit is not a problem. But yeah, I think anyone who's entering right now, unke liye there is more of a question whether you have missed the bus. If you're coming right now, what should be your expectations, etc. So those people should be cautious. Those who have already invested can look at booking some profit, but stay invested. Uh, uh, and don't over allocate right now. But looking at charts, I think Chirag can add more. You can read, uh, depending whether you have a bullish view on silver and look at 100 and 110, and even at correction, Umesh, let's say even if it goes down to 80, 70, silver has lagged gold significantly from 2011 till 2020. 2024. So it has a lot of catching up to do. So what has also happened, for example, gold silver ratio in April was 105. We are talking about historical ratio since 1998 till now, almost 66 67 if I am not wrong. So हमने 105 भी देखा, आज हम लोग नीचे भी देख रहे हैं. So it's not as if that lot of this rally is uncalled for. It's not the case. But anything which has gone up so violently, you have to be a bit cautious. But have continue to have some allocation in both gold and silver. Probably don't over allocate right now. And if you want to take a call, bit more on gold and less on silver is something which you can go with right now.
Okay. So Chirag, let me ask you a very straightforward question. What is your target for gold and silver for say 2026? I'm sure audience would like to know that also. And maybe if you can give a 3-year view also will also be helpful. I understand the targets are given today are being achieved in couple
Yeah.
of days, that also happening, but maybe at a because you've been doing a lot of research. So if you can add something there.
So I think for gold, we have a target of $5,500. These are the targets that we had when we had come out in December. So we have had a bullish view on both gold and silver for quite some time. I think gold, as I said, we continue to believe that the geopolitical scenario is pretty fraught at this moment. There is a lot of stress, a lot of tensions. Until that time things continue, it's very difficult to take a negative view on both gold and silver. So for gold, we've got a $5,500 a target. Silver, our target is at this moment 105, but with the way silver has been going, you never know, never that 105 would come in couple of weeks' time. Because as I said, in December, when it was trading at $70, we had a target of 85, which just came in couple of weeks' time. So
Yeah.
that's how gold and silver has been. But I would actually agree with a couple of things that Siddharth said. Is that if you're holding it, great. Continue to hold if you want to book profit. But at this moment, for a absolutely fresh entrant, I would say there is high risk, especially in silver, than in gold. I think gold, we are already seeing a lot of tensions which were kind of flying at Davos. We saw the speech of Mike Carney, Macron, Donald Trump. So I think on gold there is still a lot of more comfort which is there. But silver, I think it's getting a bit worrisome at some point of time.
Perfect. Thank you. I think that comes to an end. Maybe because we have a lot of questions being asked, so maybe would like to give some time to questions also. So let me just read those questions for you. So Siddharth, there's a first question for you only. I think the question is that, which is fair also. Not everybody is so maybe well versed with ETFs, and they don't want to explore the ETF option. Maybe there is another route of fund of fund. So maybe you can brief how the fund of fund works and what are the positives and things to look at while buying fund of fund, especially when it
Yeah.
comes to commodities.
So ETF buys physical bars, LBMS certified. For gold, it is 995 1 kg LBMS certified. For silver, it is 30 around 30 kg LBMS certified triple nine purity. So these bars are stored in vault. There's a physical backing. There's no purity and safety risk hence. But ETF you can only buy and sell on exchange, right? Just like stocks. For example, you can buy ETFs, silver ETF at let's say 300 something. You can buy 1 unit, 10 unit, 1,000 unit, etc. It gives you that flexibility of owning in such a small denomination. But a lot of people do not have demat account, do not like to trade, etc. For them, there's a normal mutual fund route which is called fund of fund, which invest and holds these ETF units. Here you can buy and sell just like you do with your normal mutual fund. You basically can do SIPs, etc. The only difference is that while short-term and long-term capital gains tax remains similar, tax slab and 12.5% for long-term. For ETFs, this is LTCG applies for greater than 1 year holding, and for FOF it applies for greater than 2 year holding. That should be the only thing which people should remember in terms of differential. Also, one people talk about cost also, because in FOF there's a TER of ETF also, and FOF TER also. TER, by TER I mean expense ratio, which is charges of running the fund. So, for example, in our case, let's say ETF is around, let's say 35 basis point, which is 0.35%, right? So if you buy ETF, that is the fund running charges. So if gold gives 10% return, you will get around 9.65, around 9.65% return, because 35 is basis point is the cost. Fund of fund, because it is investing in ETF, fund of fund will have its own expense. So direct plan, let's say if it is around 10 basis points, or 10 basis point plus 35 basis point is your total expense ratio of both the schemes. For regular plan, it will be a bit higher because it involves brokerage also. So while it is not significant, fund of fund has its own set of advantages. You can do SIPs, you can stay away from the noise of market, nuances of buying and selling ETF. But if you like buying and selling at intraday levels, for example, we saw, Amish, how volatile the silver was, right? Using ETFs, you can take advantage of these intraday levels also. Yesterday, also, like I was saying, that ETF was trading at a significant premium, and then it corrected. So you can do all those things using ETF, but for simple investors, FOF is also a good way.
Okay, perfect. So there are two, three questions I'll quickly answer at my end also. Yeah, I think ETFs are backed by physical gold and silver. And the second question was, is there any copper-based ETF available in India? So in India, you cannot have ETF which are backed by physical asset, barring gold and silver. So for copper, you will find metal ETFs, but not a physically backed ETF for copper. But there are couple of multiple metal ETFs, sorry, in the market. You can always look for that. So that there is one more. Before that, there is one question for Chirag also. Chirag, the question is about US dollar depreciation, how it impacts both the commodities, and what is your view in near future?
Sure. So, see, basically, I think we've seen that US and gold has a negative correlation. And this is because if you look at gold, especially, right, and the way gold is, the beauty about that one particular asset is it behaves as a currency, it behaves as a commodity, it behaves as an insurance, right? Now, both US dollar and gold are two assets which are easily acceptable across the world. So, gold is kind of vying for that space as a global currency vis-a-vis the US dollar. So, given the fact that both gold and US dollar are regarded as a safe haven asset, right? If the US dollar up depreciates, you will see gold appreciating because the money will start moving from there. Also, the another argument is a commodity argument. The commodity argument says is that as the value of dollar depreciates, the value of other currency vis-a-vis dollar increases, and that means that commodities like gold can be consumed more because of dollar depreciation. So there is a commodity argument which is there, and then there is a currency argument which is there. So that's why you will always find gold having a negative correlation with US dollar. Similarly, for silver, it's more of a commodity argument because silver is denominated in US dollar and majoritarily traded in the US dollar. A US dollar depreciation would mean that other countries can consume more of silver, buy more of silver. And this is true with every other dollar denominated asset that you will find, especially with commodities, that on a long term basis, when dollar depreciates, you will find commodity assets, especially traded in dollar, would
Mhm.
kind of.
Okay, perfect. Thanks. So that there is one question for you. Will you be managing gold and silver in your passive FOF dynamically, or it will be static? What is the current allocation pattern in case of you wish to change the pattern, when you will change?
Yeah, so we are managing gold and silver fund of fund dynamically. So we change allocation as and when needed. We launched this particular product around 4 months back, I guess, Umesh, right?
Yeah.
So at that point in time, our allocation towards silver was around 55%, gold was around 45%. Uh, Now, as silver has run up, we have gradually sorts of been decreasing our allocation towards silver. We have made some profit booking. So right now, gold allocation will be closer to 60%, and silver allocation will be around about 30% or so. Oh, sorry, 40% or so. 60 and 40, gold and silver, rough allocation.
Okay, 16. So there's a question, how about ETF for platinum and palladium? I think that's not allowed right now in India. So I'm sure asset managers must be looking for those ideas to be made real, but awaiting regulators go ahead on that. Once we get it, I'm sure we you will see those kind of products also will be launched from our side in this. So there is one more question, just 1 minute. I'll just take two more questions because we are keeping time in mind. There's a question, what are the key ways we can check premium discount in an ETF on the particular day? I think that's a very good question. I think must be having everybody having in mind. So both of you,
Yeah.
anybody can answer.
Chirag, you want to go first, or should I take it up?
Well, I can tell you how you can track premiums and discounts of the spot market.
Please go ahead.
Yeah, so World Gold Council has a website called as gold.org, which is kind of a very good repository of information for the gold market. And every week they would come out with premiums and discounts which are there in the Indian spot market, which is there. So that will help you understand whether Indian gold market is trading on premiums or on discount.
Okay. Chirag,
I'll probably tell a bit of a mathematical way. So you know what is the LBMA price in internationally, multiply it, convert into domestic price by using USD INR, add custom duty, which doesn't change so much, so you don't have to do, let's say, tweaking every day. It remains a bit more consistent. And once you have done that, you will arrive at a INR price. Difference between that and MCX spot, which is typically declared on a daily basis, is what the premium is running in India. If it is equivalent, there is no premium. If there's a difference, then there's a premium between India and international prices. So, bit mathematical way, but I think custom duty doesn't change so much, and INR USD INR can be easily found out. So you can use this and simply track it for both gold and silver as well.
okay. Chirag, there's one question for you. Maybe you can quickly answer is that is there any support level in your mind for, or maybe your research gives any number for gold, silver both?
No, we don't do technical. We are fundamental analysts, so we
Okay.
don't do the technicals.
Perfect. So, Siddharth, this last question for you. How the FOF NAV is being calculated? If you can
Yeah.
tell us that also.
That's a great question, and I'm glad that you asked. See, in India, ETF NAV is computed based on, most of us do it based on domestic prices, right? So most of the MCs have aligned it with MCX spot prices. That is how ETF NAV is derived at. But fund of fund NAV is based on the closing price of ETF on the exchange. So if for whatever reason, let's say spot was only up by 2%, ETF will show a 2% rise one day to the next. But for whatever reason, the closing price on the exchange was at 5% higher, your FOF will be valued at the closing price and may show a return of 5% on that particular day. Typically, it should ideally be same. If it is not the same, it will converge, right?
Okay, understood. So basically, how efficiently the ETF is being managed, it reflects into the NAV of
Yeah,
the.
because I know why people might have asked that. Like I mentioned in my example, that yesterday ETFs were trading at a premium. That premium went down. So if you look at it, spot price came out to be lower than what the quotation was and where the closing price were. So your FOF return yesterday would have been different to what ETF NAV to NAV returns were, because there was a difference in the exchange closing price versus the ETF NAV.
Thank you. Well, thank you, gentlemen, for this session, for this discussion, for clearing out our doubts. I think still there are a lot of doubts pending, and I can see a lot of questions are still unanswered. So, to my audience, we will come back with if there is any question which is not being answered, we'll try to answer it from our side. We'll send a mailer and maybe one-on-one also. You can also ask us question on our social media platforms as well. And also we'll come back. I just want to say bye now, but with the promise that we'll come back again to brief you more about these commodities or any other ideation which is need to be answered or discussed. Be assured with that. With that, thank you so much and bye bye.
Thank you.